Hi, I'm Andrew Chambers and welcome to another week of Subject to Finance on this Monday, the 4th of September. We're into spring and it feels like from the little bit of feedback I'm getting from the market in terms of agent activity that things are starting to feel a bit springish. Certainly agents getting some listings now, which is good to hear. I hope that's you. And also a little bit more sales activity. A few more people finding that they're contesting in negotiations again, which I think is something that buyers are going to have to get back into the mindset of over the next few months ahead. This week I am talking about the household. I've touched on this before, but I thought I saw something called the Great Refix mentioned by, I think it was Westpac, and I thought in a way it's actually a really interesting kind of analogy in that at the moment households are having to do a big rebalance. And the Great Refix is that the fear of that up-and-coming refix of the loan, if you like, and what the impact of that is on your household expenditure. We've probably seen the worst of that now, but we've still got people out there on rates that are in the threes that are, seeing that move up into the sevens. And so, that's a major reshuffle in terms of thinking about how I cope with that as a household. Where does that money come from? It's got to come from somewhere. So today I thought I'd talk about that balancing, and I think my observations here are we all know that interest rates have skyrocketed, and we know the impact of that, but we haven't really talked too much about the other things that are going on in terms of income and expense at a household level. So here are my observations. I think we're doing well, and I think that on the whole, from what we're seeing, households are doing a pretty good job at coping with these increased costs from an interest rate point of view. But there are some things that have really helped, and one of those is wage increases. So actually, at a time when things have been pretty hard for households, we've actually seen some significant wage increases, and actually over the last 12 months above average. So that's kind of boded well for households. It's given them that little extra. It's much more meaningful than things, I think, in things like the government politicking that you're hearing at the moment around that extra $250 or whatever if you're eligible, caveat, etc. Wage increases really do make a difference, and because of the pressure in terms of employers trying to keep people, keep them happy, and the risk of not being able to replace them, I think that sort of pushed those wages up. But it's actually come at a good time. So that's one thing. So if you look at the averages, wage increases have been above average over the last 2 years actually, I think. And the other big thing that I see in terms of cash flow, if you like, for households is that we had an impact that came off the back of COVID. And that was that there was a lot of people sitting around still earning, still being paid a salary, and not doing a lot. And so actually at the moment households are collectively sitting on around about $30 billion worth of savings. And that really was accrued through that COVID period. And so I think from a household balance sheet point of view, a lot of households are actually not too bad at weathering storms. Now, I'm not saying this applies across all demographics. I think the lower end of the income spectrum are really finding it tough. I'm not quite sure why we've had a week of the stretch middle, because I think actually they're probably more resilient, but that lower end, it's very much money in, money out. But in the middle and the upper end, if you like, household savings aren't too bad at the moment, so that's a real plus. Now, the other thing that we're sort of starting to get a feel for, and this is stuff that's been driven off the back of inflationary pressures to some degree, but also just again balancing the books, income in, expense out, is that Kiwis are managing their wallets pretty well. And if we look at things like retail sales, it's not great for the retailers at the moment, unfortunately. And there's been some pretty big quarterly changes there. Discretionary spending is about 4% down quarter on quarter. So that's a fairly healthy sort of decrease. That'll be really challenging in terms of retail out there. So for those in retail, it has a negative side to it. But really the only thing that is showing some growth in that sector is motor vehicles, and I think that's driven off people getting into the EV side of things, particularly before changes happen and they don't get those subsidies. So that's one thing. I think that's also, I mentioned last week, been stimulated a bit by the 0% interest loans that banks are offering for clean energy items such as EVs. So motor vehicles is up. The other thing on the motor vehicle thing is during COVID, supply chain was broken and it was very hard to get a car. So you were generally being put on wait lists to get one. And so that with supply chain freeing up, that backlog's probably finding its way of balancing back out again. Pharmacy's up. I'm not quite sure what's driving that. But yeah, for some reason that's up quarter on quarter, and department store activity is up quarter on quarter, and I think that comes back to households making choices. And generally, as we all know, department stores are a cost-effective way of keeping our family in clothing and other bits and pieces. So I think that's probably what's driving that change. It's probably coming at the cost of some of those sort of more boutique retailers taking cuts or hits. And apart from that, the only other thing that's really showing signs of improvement quarter on quarter is accommodation, and that's driven by tourism returning, World Cups and bits and pieces. But overall, it's fairly subdued, and it really shows that Kiwis are keeping their money in the bank and aren't out there spending it as much as they were. And that rebalancing seems to be happening quite well. So that's my kind of little piece around the household. I think actually New Zealand households are doing a pretty good job overall. When I look at where it stands compared to the recession of 2008, the GFC, at that point in time the interest costs were actually higher, and I think wages hadn't actually had those sorts of adjustments as and as a result of that, the cost of the home loan versus the household income probably wasn't actually too disparate to where it is now. So yeah, good signs there in terms of households being able to get through, I think, over the next 12 months, although it's going to be tough. Other things this week, rates just really quite static at the moment. There's little ups and downs, but generally what we're seeing is that interest rates sort of remain seated, if you like, and I don't think we're going to see too much change in the next little while. It seems to be a lot more stable than it has been for a while, so that's good. I think it probably makes things easier for those that are looking at getting a home loan. It feels like that upward pressure is a little bit off just at the moment. So yeah, I think that's a great sign for those trying to do the numbers and work out what they can afford. But apart from that, no other major changes this week. So have a great week, and look forward to catching up with you all again next Monday. Cheers.